Recovering from illness, it's James Whelan and the Theory of Thing Investment Podcast. I am joined by Heath Moss of HLM Investments. Heath, how are you now?
Very well. Good morning and good afternoon, good evening, depending on when you're listening to this. Hope you're well.
Sounds
it's
good, the old Ken,
good to hear your
Ken Vixler intro.
Yeah, good to hear you're getting better there, mate. I know you were pretty crook to start the week.
Yeah, mate, she was a bit of a rough one, but we do not have a chance to stop, unfortunately. Just to note, everything that you hear in the Theory of Thing Investment Podcast, which is being recorded on the 21st of September, I still sound sick, on the 21st of September 2023 AD, is general advice, not advice. I keep effing it up, mate. What you're hearing is not advice. If it is advice, it's general in nature. How does that sound? I'm going to get that
go
right.
Go see a professional financial planner if you get it
you
before
should go
you do
and see
anything.
a professional. Yeah, right. Yeah, you'd think that like 18, almost 20 years in this industry, and I still can't do the general advice disclaimer. Right. You know what? By the time I get it right, they're going to remove general and personal advice.
Yeah,
that's going to be advice. there's our little CPD points for you. They're going to remove general advice. It's just going to be best advice principles, and it's just going to be: is this good advice or is this not good advice? I can tell you some advisors that do good advice, and I can tell you some advisors that don't. But I'm not going to mention them here because we don't have a legal team that's big enough for what's going to happen after that. All right. So look, it's a beautiful Thursday. Thank you, everyone. Hello, everyone who's watching on the YouTube channel as well. To all the subscribers, I got myself a nice cup of English breakfast. I am out of my quarantine, my self-imposed quarantine of a few days. I've just been absolutely slammed. Amazingly, I moved house, so those boxes did get transported that you saw last week. Those boxes got transported from the Crow's Nest place. I'm in the Northbridge place. Fantastic. However, shifting boxes for a weekend, and then you have the dust and the brick dust and the dirt and everything that you have around a newly built property, a newly built construction, and also the fact that windows are open and so you feel a bit of a chill. All of those things, aches and pains, clogged up nose, and just generally feeling chills, they all are the same symptoms of actually being sick. So I didn't actually know I was sick. And Monday morning, I'm just like charged off to work in my suit and tie and get there, and the guys are just like, "You need to go home, dude."
Get out of here.
The VFS guys we're pretty picky about this sort of thing. I'm just like, "What are you talking about?" It's, oh wait, hang on, yeah, this is actually I've got a virus here. Scooted back home and then basically slept for the last on and off. I've had the laptop in there. You wake up. You do what you can, get onto client stuff, do emails, check in with the market, and then just pass out again. It's been It hasn't been the over and above productivity that I would have usually achieved this week. Mate, what about you? How are you going?
There's one, very well, not sick. Glorious weather here in Adelaide. I mean, getting to that real spring warm weather. I noticed in your notes you mentioned how hot it was in parts of South Australia this week, and I think the Riverland, Renmark got to 36 or something, whilst Adelaide was only about 20, 22. So there was a real gap there. But glorious. But the one benefit that's come from COVID has made everyone more aware of illnesses, etc., and more accepting of, okay, if you're sick, just stay home, do your job from home if you can, or just take some time off. They don't want you in that office in that closed-in space. Spreading it around, so that's actually one benefit that's come from all this the pandemic we just had.
Well, this is something that I want to talk about, and this is actually something part of the investment case that I've got going forward as well. And I'm sort of building a bit of a structure around this thing too. Is that when we're doing the podcast, when it was called back in the Bip Show days, and I was saying to Paul and I disagreed on this one. Paul and I disagreed on a lot of things. I wasn't vehemently disagreeable enough on some of these things because I wasn't really confident in some of the things that I was saying as much. I was just like trying to listen to the experts and go ahead. But vehemently, we were told, we employees were told that IT departments couldn't give us those 1 or 2 days at home a week or a fortnight that we desperately needed to get our lives back in order, to do banking, to go down and spend 2 hours at the RTA, or go, those things that you need to do. I don't want to take work off, but I just need to be home, or the kids are sick. Just one of these little flexible work environments. I just need this to happen. Look, I've just got to go. And IT departments everywhere said, no, we can't do remote access. We can't do work from home. It's too hard to do. We managed to do it because we were a small shop and we were okay. But big places, I didn't realize just how incapable big places actually were. And this is me. I built the business continuity plan for Pershing. I built virtual the the continuity plan that allowed people to be able to remote access in. It was really hard to do, and it was sort of a special occasion thing for a situation like a pandemic. I built that, and it was tested, and it worked, and it was fantastic. That was really hard to do, and banks everywhere and big places everywhere said that it can't be done. It turns out that when the pandemic hit and everyone had to go home, it turns out that the IT departments could get it done in a matter of hours. Wow, thanks guys. And then to actually make it secure, I know it took longer than that, and then to actually make it proper and secure and working, only then took them another couple of months. And then they realized that we're actually still functioning. The world hasn't ended. We're still going to be able to go, and people can come back to the office and do it. And I said from that, and this is me sort of overseeing what I'd overseen before. I said from that there was this huge change that was going to be happening in markets, mainly from that social level of people saying, I know that you can do this now, so I'm not going to go back to the way that it was before. I know that I can have that 1 or 2 days, and I know that you want to offer it to me, and I know that you're trying to offer it to the guy who's trying to come in here. So I want that as well. And that's what started the social change here, definitely in America, of people saying, I don't need to be there 5 days a week to do my job. And it's crazy for you to ask me to do that, especially with all this other stuff that I've got to do. And that was that social change that we saw. And that's why commercial property has been maybe not as bad as it could have been, but definitely a pretty ordinary situation. And so I'm going to bring this up. Now, this is my next part of my thesis. It's not about crops, so don't worry about that. This here, we're going to start with this one. American workers are striking. Strikes are the next big thing. And I've said this privately, and I've been shot down for it in a few places by some pretty high-level guys. I'm just like, no, this is the next big social change that is actually going to move markets, and we're actually now seeing it to move markets as well. American workers are striking at a pace not seen in nearly a quarter century. Last month, this is Lisa Abramovich. She's amazing. Large stoppages from strikes resulted in 4.1 million missed days of work, the biggest monthly total since August 2000, and that's from the Labor Department. You can see that chart there, and I'm looking at it now. 4.1 million days lost in August. That is from strike action, the biggest since work stoppages back in the year 2000. Do
you think it's any coincidence it has come along with the rise of AI and probably more automation? Yes. I mean, you got the writers' strike that's been going on for a while. Yep. They've been going for, and AI is definitely a part of that. They don't want their likeness or voices, etc., used without being paid for, etc.
Correct.
You got the car manufacturers' strikes, which, I mean, they're asking for, I think it's 40% pay rise over 4 years, so 10% a year, which to me is a little bit too much. But maybe they're trying to milk everything they can before they lose their jobs, regardless, because of automation. And then you've got the one that the outlier is the Chevron LNG strikes that's going on at the moment. That's lasted a week or so, which is sort of the outlier. But those other two major ones, the riders have been going on for a while, and the car, they look like it's going to go for a while because they're so far apart on the agreement. And then those are really going to be heavily impacted by AI and technology moving forward. So it's interesting.
And there's more to talk, and this sort of goes on to the next thing. We'll get to that in a sec, but I'll let you charge it. That this will spread. I'm not saying it's a good or a bad thing. My family were old through my mother's side, actually through my father's side too. We're old school unionists. I'm sort of the first person that sits on this sort of different side of the tree. But I love the ability for workers to stand up and say, no, we think that you guys are taking too much of the pie. And we're pulling our weight here, and we need to be remunerated for it fairly. We see the bonuses that happen at the top. We see what your quarterly reports say that you make. We see what you can afford to be able to pay us. And
hello, Mr. Alan Joyce.
Yeah, let's name names, mate. That's son of a. He's mate, I'll tell you what. Joe Aston is. I haven't caught up with him for a while, but I am going to buy him a lunch. He's done some amazing work lately, just laying into him fantastically. With people's ability to stand up and as one say, look, we need to be remunerated more. We can see what it is that you're doing. I hate the idea that, and this is one of those things that's always annoyed me. Two things. When COVID hit and everyone suddenly found, the companies suddenly were just like, oh, we're out of money. We only had 2 weeks spare. That's what you had. All of that money, all of that cash flow. You could only last for 2 weeks. You can't shut down for 2 weeks. All of those buybacks, all of the insurance money, all of those the cuts that you made to everything, and you couldn't survive. Whereas we all had to survive without anything. Some of us did. And so yeah, we bailed out a lot of these companies to be able to survive through it, and we didn't get anything back. That was our chance to actually take ownership in some of those companies that could do it and make them earn it back, as the same way that everyone has to earn these things back. We've got to earn back our COVID relief payments in higher taxes and higher interest rates. That's us paying it back through higher inflation, which isn't going to go away. That's us paying it back. Make them pay it back, and we should have taken a chunk of Qantas. Should have taken a chunk of the car industry. So should have taken a chunk of all of those things in America, but they didn't. And now they're in a situation where it's all just coming around again. The buybacks are continuing, although they are slowing. And you know what? The American worker just has had enough of it. And when they all stand up together, the same as they've all stood up for work from home, this is now where it's at. Not saying it's right or wrong. It's just, I do like to see a group of people stand up and say we want some more. It's healthy. It's healthy. It shows that people are human still. For as long as we are human, it shows that they are.
Yeah, well, whilst I don't agree with all of that, I think you raised some fair points there.
Okay.
I'm on. Yeah.
What have you got?
We can sit here for hours.
What's your so charging on now? You've got some notes. Let's talk about markets. Let's talk about things. Oh, before we do, sorry, I know that I've been gas bagging heaps, man. I'm going to let you bag your gas. Bag your gas. I'm going to let you gas your bag.
Go for it. I know you got important things.
Yeah, we're in the suit and tie because tonight I am hosting what am I hosting? I'm the MC. I'm the MC for the 10x10 philanthropy charity event that's happening over on Carrington Street. Hosted, we are the guests of MA Financial, putting us up at their digs too. If you're listening to this sometime in the afternoon and you want to head over in the evening, kicks off, I don't know, about 6 or 6:30 or something like that. You pay $100. We get 3 small charities to come, and there's small startup charities, only new, but they're making an impact, and we've picked them out on the committee level. And they come and they make a pitch. They got like 5 minutes to make a pitch. They get 2 slides, so it can't be a fancy thing. It's actually to say, this is what we do, this is how we help. And then we get a shark. We've got her name has just escaped me because I don't have my notes for this one, but I'm going to do a better job as MC tonight. Trust me. We get a shark, and she's started up a few things, and she's sold a few things, and she's amazing. She's like actually one of those Shark Tank sharks, and she peppers them with a few questions. It's all very friendly. It's all good, but about how it's going to happen, how it helps, how they work, and all things like that. And then everyone who's paid their money, you get a voucher for every $50 you've contributed. You get a voucher, and then you get a ticket. You got to decide where you're going to allocate your tickets on the 3 charities, and so then from that we split it up as a percentage to see who's going to get what. There's no winners. Everybody gets something, so everybody gets helped. But it's just sort of a fun sort of. It's got that financial services spin, allocator. Trying to pick the best business case and trying to see where, instead of how much money are we going to make, it's actually going to be how much help are we going to do and how much change are we going to make, and who needs this to actually get that equation back level, which is great. So that was us. That's us tonight, and so I'm hosting that. So it's going to be a lot of fun. I'm really proud of the work that we've done. Well done to everyone. Global X has contributed a massive amount to it. So well done, Nat Jollo, who's a good friend of mine over at Global X, and the work that she's done getting that done. And if you want to help out, 10x10 philanthropy, just Google 10x10 philanthropy, and it'll link you to everywhere that you want to go. Check it out now. It's a really good way to help out good small startup charities. Stay away from those guys in the streets with the clipboards. Your money is not really going to end up anywhere with them. Go small, and this is the best way to go small. Grassroots. Over to you, Heath, with the market report.
A fantastic cause that. So well done on that, Mel. Well done. So what are we talking about? You want to bring some charts up there? You're in charge of the buttons.
Why are you in charge
of the
buttons? Okay, fine.
Gee,
that's a candle. You want to walk us through that candle for the listeners at home there, mate?
Candle at the end. That's last night's. I just drew a little line there showing the support over the last couple of weeks where it bounced off of it and broken down below it. That orange line up there is the 50-day. We've got the 200-day there. Again, looking bearish. We're making lower highs here. You can see the high there, and high there, all lower. And it looks like we're going to make a lower low coming in. So, of course, we had the SPX is down about 1% for the week. And we had the Fed last night come out, as expected, held. But all the main focus was on the dot plots. They do these dot plots every quarter, and last night's was one of them. Basically, the crux of that was that next year they expect rates to stay higher for longer. The average median expectation went up from 4.6% to 5.1%. Market didn't like that. We had the yields fly. They're at highs they haven't seen since 2006. So you can see the 10-year there at 4.43%. The 2-year is at 5.2%.
Look at the 2-year. That's insane. Okay, so I go. I'm going to take a chunk of my client's money, and I'm going to put it. And for 2 years, I'm going to get over 5% per annum.
Yes. Yeah.
I'm taking into the FX risk. You tell me how freaking easy that is. That is a free kick.
And that's what we've been saying for a while. And you take it back to the SPX. Trading at 18.5 times forward earnings with a cash rate around that 5% mark. I mean, it looks expensive to me.
Yeah.
I mean, especially with earnings growth quite benign. And we've got, I'll bring up the Dixie, the US dollar Dixie. Scuddy tweeted this morning about a golden cross possibly happening here between 200 and 50-day moving averages.
David sold Scuddy on the old technical analysis, mate. You beauty.
Yeah. He's back on the bandwagon. Got his new job. I think is it City Index. Is that where he is at the moment? I can't remember.
It's called the guys who own City Index. And it's cool. But he's killing it too. So it's good. Good on him. He's getting that done.
So that for the technical gurus out there, that's a very bullish indicator. Would suggest US dollar is going higher. And that's going to be a headwind for earnings moving forward. I mean, at the moment, they're expecting basically earnings to be flat in Q3, or they'll be revised down. Earnings for Q4 are expected to be around that 7 to 8% growth. Expect to see a bounce there, mainly because of base effects, because the Q4 last year was so bad. But again, I think that will be revised down. So you've got a US index, the 500, trading at quite lofty levels in terms of its forward earnings ratio, etc., and bond yields giving you 5%, risk-free basically. So I mean, there has to be. I think there has to be some a correction there, and I think we'll see that 10 to 20% correction there in the first half of next year, alongside. I'm still saying alongside a US recession. I don't believe rates are going to stay where they are. Some of those cuts next year have been started to be priced out of the market. The 100 basis points that were there a few days ago is no longer there. I think it's come down to about 50 to 75 basis points. So, but I think, US recession next year, market corrects 10 to 20%. So nothing too major. I'm not talking pandemic or GFC levels here.
Right.
That's about it for the US markets.
That's the market report. So also what was amazing is that I had, where did my Word document go? This was a survey by the FT and the Chicago, let's just say the booth. It's on the FT, Financial Times. It's the FT booth survey that came out first thing on Monday morning, overnight, just before everyone started. It talked about the recession calls and the interest rate forecasts of economists in America. And it was sort of interesting because it was a thin day, and I don't know if it moved markets, but yields started to pop. No, it definitely wasn't because of this, but that was them at the beginning of the week with the results of the survey that the FT and the Chicago Booth University, whatever they were called. I'm going to say exactly what they are, but anyway, don't worry about that. 42 economists surveyed, just saying that they see that they're delaying their recession calls, but they are still there. But, and I'm just going to pull this up for you as well. What is your prediction of real GDP? There was a prediction here about rates. Anyway, in effect, the economists survey think that rates going higher is more of a certainty, or sort of was more of a chance than them not. And we saw that last night with the Fed, exactly that they were correct. So yes, yields were going to go higher. They predicted it. It was correct. And that was how that went. I'm just going to see if I can just yank it up here. And
just on that delay, I actually heard a really good theory around why the recession has been so delayed and hasn't come forth as soon as we expected. It came down basically them saying net interest rates, what the consumer is paying for their interest versus what they're receiving. And you think about the consumer is very long duration in terms of mortgages, which are around, you've got most 80% of US mortgages are below 5%. And so then you have on the other end of the spectrum, what they're receiving in their bank account is well above 5%. So they're still benefiting on the short end, while they're also benefiting on the long end in terms of where their mortgages are. So until that starts rolling over more, the consumer still stands to benefit.
Okay. Well, and you can see. Can you see that what I'm sharing there on the screen? Yeah.
Yes, I can. Yes.
So this is from that survey, and I'm just going to flick through some of it. This is oil supply restrictions top the list of inflation. This is the inflation risk that we're seeing there. Oil suppliers are massively ahead on the inflation risk. We have seen that will factor into it. Oil heading towards $100 again. That's them moving past their recession calls, and I said that before. And what was this one? This was a good one. They ratcheted up their growth. They ratcheted up their growth forecast. So yeah, it's based on the fact that the US is going to keep on going okay. That's that.
That's soft or no landing sort of scenario. Rates for longer, higher for longer. That seems to be the theme at the moment, which I'm not buying into. But that's what the market is saying, and it's probably why the market's still trading that 18.5 times forward earnings. It's a very
tenuous path. Like they've got to really. I mean, this is just the acrobatics that need to be done to make this happen is phenomenal. Now, moving on, what was the next thing that we're going to talk about here? Uranium.
We can chat uranium a little bit. Yeah.
Go uranium. You got a bit on uranium. Go.
Beautiful. It's looking good. Spot prices at I think it was 15-year highs, around just under $67 a pound. Basically, we had the World Energy Association, one of those associations, come out about a week ago, talk about the shortage and the dire situation that we're going to face in uranium. Now, my opinion was always, I was really worried about that shut-in production and all that production that's come offline. Once that spot price hit a certain price, it would come back on and flood the world with more supply. But apparently, even with all that coming back online, is it brings our total production up from 140 million pounds to about 174 million pounds, and we're in a deficit of around 180 million pounds. So still not even encroaching on that deficit. And they're saying by 2030, we're going to need about 230 million pounds along those lines. So we've got India, we've got China mainly leading the way. There's 39 reactors under construction at the moment in those two countries. Sorry, and it's basically about just being really in short supply of uranium. We know Germany have turned off the taps in terms of reactors, but then they're importing their power from France, which 60%, 70% of their power comes from uranium. So uranium reactors, especially the small modular reactors, which are becoming very, very popular, are coming online, and it's the base case for uranium is starting to look very, very good again, and we've seen that reflected in the prices of uranium stocks. I don't know if you've got charts up there for me at the moment. I'm just going to bring up the local uranium ETF here from BetaShares, URNM. BetaShares uranium miners. You can see that massive uplift there. It's up about 30% in a month, and that goes along with a lot of stocks like Platinum, Boss Energy, DPLO. All those guys are moving up quite strongly. Beautiful names. They got a bit smacked around yesterday, though. I don't know why. I was looking for a reason why, but I couldn't find one. But uranium. So keep it on your radar. It is looking like there's a sort of a stronger momentum behind this move and longer term direction there, and I think there could be some more legs in this yet to come.
Okay, not bad at all. There was one last thing that I was going to talk about, and it's absolutely disappeared from. Buying opportunity. I mean, ideas of the week. I'm still long fuel, which is great. I haven't really put any changes into. I'm about to go deeply long bonds locally and also in the US, like the last of the last straight fixed allocations. I've managed to make a few tweaks to the offering that we've got so that we can actually have more options available to us, which is great. So that's me working my ass off here at VFS to get that done. If anyone would like to know more about that, then please let me know. But it just means that we are, and it means that I can actually go and load up on some of these things, which is what's going to happen. And I don't really care about, you're going to miss the top, you're going to miss the peak. I'm not trading these. This is actually for super fund clients. Load up, retire with some of these things. That's where I want it to be. I think I was looking at a 40-year Australian note that was at 4.4% or something. I don't know what it was.
Year.
Yeah, something like that. Anyway, it was a 2047, so it was like a 20-something year. But I just remember there being, as I was flicking through them, just going, you know what, that's there, it's ready to go. Just put it in and just collect. And there's those little simple things. I haven't done all the homework on it, so don't quote me on that. But that's where that is. Still long fuel. I think that anything is a buying opportunity in tech, based on what Scott Helfstein said last week from Global X. I'm a complete convert on that whole idea. The Magnificent Seven is still going to be Google. I want a chance to have another go at that as well. I'm hoping that this will be another chance to have another crack at Google. Big cash-rich companies, they don't care about your stupid discounted future cash flow thing. That is something that only applies to people that need to worry about the price of money.
I'll push back on that a little bit, because I also agree with that it doesn't directly impact their balance sheet, but it directly impacts their customers. It directly impacts their customers. So and how much they can purchase in terms of their cloud services, their AI services, and etc. from them. So whilst their debt, in terms of the debt side of things, it really doesn't matter for them. It will impact who's buying off them.
The people that are buying for it, that's true. Which again, to think that sits alone though in a static environment with some of the smartest, most cutting edge companies in the world is okay. You are correct. It does impact them. That's something that they foresee, and that's that not a next level with what they can do. Their enhancements to productivity that they're making as well. I didn't even touch on that last week with the enhancements to productivity.
No,
that just how cleanly they are cutting through the mess, get past the very cringy Mother Nature crap that Apple did last week, which I'm still reeling from just how awful that ad was. Did you see it?
No, I haven't seen it.
Tim Cook having a conversation with Mother Nature, pitching their environmental. If I bring it up, is it going to work on this?
Well, apparently Apple invented the USB-C port, apparently. So, as of last week.
Okay, hang on. Let's just see if I can do this. Tim Cook.
I think in terms of buying tech, I think next year if we do get that 10 to 20% pullback in the US, that will be the opportunity to load up. That will be buy your Microsofts, your Apples, your Amazons, Googles, etc. Tesla, chuck Tesla in there, and go for your life. Because I think, like you said, it's got a lot of legs, a lot of runway to go. This tech advancement and AI and whatever else comes with it. It's the next big leap in human advancement, I think.
Yeah, well, I am going to hang on. Here's what I'm going to do. Right, I'm going to try. Stick with me. I'm going to try just to close this off before we do footy tips. Hang on, I don't need to do that. I'm going to try my absolute best to get this to come up, and I'll just do it in a few different things. You tell me if this works. Is this working?
Yeah, it's coming up. It's slow, but it's coming up. There we go.
Girls, yeah. Yep, so it gets to the end. Mother Nature comes in.
You can see we've innovated.
And cringe have just been reached. That's it. All right, now footy tips, mate. What do we got?
You've
been golden. You're the golden child.
We had the big sound last week. The big sound. They came through. They flogged Port here in Adelaide. They looked really, really good.
Yeah.
But my tip this week is Carlton to cover the line. I think the line's 3 goals, 18.5 points at the Gabba.
Okay.
They're in really good form still. That win over Melbourne, they had no right to win that, but they found a way. Yeah. I think they'll get within 3 goals of the Lions at the Gabba, so that's paying $1.90. I don't see GWS getting up over the Pies, the MCG, as much as I will be barracking my butt off for them. Yeah. Hopefully next week we can come together and talk about the big sound again. But yeah, that's it. Carlton to cover the line at the Gabba. I think it's 3 goals.
Well, NRL. I think that both of the favourites are going to win this week, but I do think that NFL has started, and I'm a big football fan. I think that your San Francisco 49ers will get it done and get it done convincingly. the line on them. Now, this is tomorrow, 10 a.m. So you're going to listen to this on the Thursday evening to catch this one, and we'll see if we're right. I'm sorry that I always do this too early in the week. 10.5. They'll beat that against the New York Giants that have gone hot and cold. Lucky to get away with one last week, but I think that they're going to get thrashed this week. I think 10.5 is actually not enough. So happy to take them on there. There was an interesting moment was it the Chargers game? McVay called, they were down by 10, and the spread at the open, because they've done this huge deal. So gambling is now legal in America, right? They've done all this deal with the bookies.
Yep.
So that it's now on. And this is funny. The spread at the start of the game was 7.5. Okay? You with me?
Yep.
And the Chargers were down by 10. I think it was the Chargers. Yeah, McVay. The Chargers were down by 10. They had the ball at their 30. So with about 3 seconds left. So either you run the clock, it doesn't matter, we're going to lose anyway, or you have the Hail Mary. At least we lose, but at least we scored a touchdown. Who the hell cares? They kicked a field goal to make the difference 7.
So they covered the spread.
So the spread was covered. Out of nowhere. It was the wildest thing of just like, and everyone's just like, oh yeah, it was 7.5. And it was just like, this is insane. That's how sports are now, man. But I couldn't believe it. So that's that. That's the show this week, mate. Have you got anything else to put in? Please let me know. Otherwise, I got to go and get myself all set for the rest of the day.
No, that's it. I'm all done.
Thanks very much for joining us, everyone. I still am James Whelan of VFS Group, and I've been joined by Heath Moss of HLM Securities. Heath, thank you very much. Everyone, have yourselves a great weekend. Stay safe and mark well.
Thanks, everyone. See you soon.